investors my age and above they remember this, and they're like, oh man, that we do not want to get into a situation where we have an energy crisis causing inflation, causing stagnation, which is in effect stagflation, where you have a rise in the prices of everything at the same time as you have the economy rolling over. Okay. So that brings us all the way to Monday. So this all happened over the last 2 weeks, right? So all of this is happening, and the markets hate uncertainty, and they're all over the place. Gold's going down, Bitcoin's driving sideways. It looks like the market's turning over. And then this weekend, you get you get a little bit of optimism where it was kind of, well, is the Fed really going to be raising rates into this?
We begin in October, a pivotal moment that triggered a massive deleveraging event across Bitcoin and the broader cryptocurrency market. At the time, Bitcoin had been trading near all-time highs. Sentiment was strong, confidence was high, but then came a sharp and sudden reversal. Around October 10th, the market experienced a severe drawdown, the kind that forces leverage players out of the system. From there, Bitcoin didn't immediately recover. Instead, it entered a prolonged period of weakness, grinding lower into the end of the year, followed by additional downside in late January and early February. By that point, Bitcoin had fallen roughly 50% from its peak. This is critical because that drawdown reset positioning. It flushed out excess leverage. It created a new baseline. And that baseline matters when we compare Bitcoin to other asset classes.
I think, we have to start with October, where we had that major deleveraging event in Bitcoin and cryptocurrencies as a whole. Um, when we had that huge drawdown, if you go back and just look at Bitcoin had been trading at all-time highs. And then, October 10th comes and you have that massive drawdown. And that kind of just led to Bitcoin bleeding through right to the end of the year. You had some sideways movement and then another drawdown in the end of January and the beginning of February. And so it had come down a full 50%. And so now that's kind of where your starting point is. In the same time, gold and silver had been ripping to new highs. And your traditional safe haven assets kind of became these they became high flying leveraged plays where you had new investors and old investors alike, and then young investors looking at gold and silver and saying, wow, these things are going to double, triple overnight. I'm going to get in them. And then there was some euphoria there. And so they got a little bit ahead of themselves, in my opinion, in the short term. So that's kind of the starting point. Then you have this war that starts. At the same time, you've got uncertainty at the Fed. So there's all these things that are kind of playing into, they are all factors that are playing into the market right now. If you look at the general market, yeah, it's still near its all-time highs. It's off about 10% from its all-time high if you look at the S&P. But the Mag 7s that had run so hard over the last 2 years or year and a half they've come back a little bit. So your major Mag 7 stocks, which make up a large percentage of that S&P, are down 35%. So how is the S&P up? Well, it's been a rotation of capital. So even though those are down, you have people going to more safe haven assets, and now companies that are involved in energy and energy services, and then of course you've got your defensive stocks that people are running to, and the high yielding stocks, and so you can't just take it on face value, and picking points of performance is difficult. Now, that said, you get this war that starts, and you get a drawdown in capital, and people start selling. This wasn't an event that I've talked about before. Giovanni, you might have heard me talk about a correlation to one event. I've seen a number of them in my career. 1998, the 98 long-term capital management meltdown, then the internet bubble in 99, 2000. And then, of course, the great financial crisis and then COVID. I mean, these are all correlation to one event where it doesn't matter. There's no safe haven asset except cash in the near term. There's no place you can go without losing money. So we didn't have that. But what we did have, it was an obvious deleveraging in the general markets once this war started. And so what happened was you had investors looking to assets where they can maybe take some gains, take some chips off the table, go into cash and be ready for the possibility of a margin call and just take some risk off the table. And one of those assets was gold and obviously silver as well. And so that's drawn down. It had such a great run over, up over 100% that people were like, well, over the last couple of years, that people are like, let me take some money off the table here to be ready in case we get a margin call. At the same time, Bitcoin kind of ground sideways and was up a little bit against gold. And the reason for that is what we just laid out. It already had a 50% drawdown. And so it wasn't the place where people are like, oh, I better get out of this because it's lofty. It's already had its run. No, it's had its drawdown already.
One of the more surprising dynamics is Bitcoin's relative stability during this recent period. After a 50% drawdown, Bitcoin had already absorbed much of the selling pressure. So when new uncertainty entered the market, investors didn't view Bitcoin as overextended, unlike gold or equities that had recently surged. Instead, Bitcoin moved sideways, even gaining slightly against gold. This suggests a key shift. Bitcoin is increasingly being viewed not just as a speculative asset, but as a resilient macro asset in certain conditions.
The question is does this drag on for months and months and months or years? And if so, what does that do to energy prices is what it really comes out to, right? And so what you've seen is over the last couple of weeks here, you had the Fed speaking, and they were talking about inflation worries. They were explaining how inflation that's caused by tariffs is kind of like a one-time deal, and then the prices reset and they're where they are, but it's not an ongoing inflationary effect. And but what you heard out of the Fed was, hey, we're going to take our time here. We're going to watch this. We're not rushing to lower rates right now, because now you've got an issue. You've got a situation where you've got prices rising because of energy costs. Well, why would that happen? It's not just oil and gas that rises. It's that oil is a critical component of every single price of everything that we have. It doesn't matter if you're talking about gasoline at the gas pump, or the clothes we're wearing, or the food that we're buying, because it's either made with oil and oil components, or it's sent around the world and transported and distributed through the use of oil and energy. And so if oil is expensive, everything's expensive. And that's what the Fed is worried about. And that's what investors are worried about. So if you look at the Fed funds futures, 2 weeks ago, we were pricing in about a third or a half of a percentage cut, a third or a half a probability of a full rate cut before the end of this year, or a full rate cut by the end of this year, one full rate cut. And then last week, it just completely flipped. And not only did we price in that there's no rate cuts coming, the market started pricing in a rate rise. And so that had everybody on guard. So now you're seeing things like the 10-year Treasury, the 20-year Treasury, the 30-year Treasury, those yields are going up. Why would they go up? Well, because investors are worried that there's an ongoing issue with inflation, and it's structural. Because if you go back to the 1970s and 1980s, Giovanni, you're a little bit younger than me, but I lived in that era here in the United States. And when we had the Middle Eastern conflict back then, same players, Iran and USA, and we had a spike in energy prices, and we had actually a shortage, and we were rationed gasoline for our cars. Investors my age and above they remember this, and they're like, oh man, that we do not want to get into a situation where we have an energy crisis causing inflation, causing stagnation, which is in effect, stagflation, where you have a rise in the prices of everything at the same time as you have the economy rolling over. Okay. So that brings us all the way to Monday. So this all happened over the last 2 weeks, right? So all of this is happening, and the markets hate uncertainty, and they're all over the place. Gold's going down, Bitcoin's driving sideways. It looks like the market's turning over. And then this weekend, you get you get a little bit of optimism where it was kind of, well, is the Fed really going to be raising rates into this? Probably not, because of two things. Well, one thing is they know that raising rates to battle inflation driven by energy crisis that doesn't work. All you're going to do is drive the economy into a recession. In fact, a friend of mine, Kyle Bass, he just quoted that exact same thing this morning, and I was writing about it this weekend, and in my newsletter. And basically, you've got this issue where the Treasury has so much debt that it has to refinance every single year now. And that's a whole nother issue that we can talk about. But basically, we've put ourselves in a position that, number one, we have $39 trillion of debt here in the United States. Number two, we're running deficits of over $2 trillion. Number three, those deficits are going to rise to $2.5 trillion or more if we have a prolonged conflict and Trump spends $500 billion more on defense like he's talking about. And then the last thing is, we've got so much debt that comes due every single year because we didn't term out the debt. We've been issuing T-bills to kind of kick the can down the road. You're talking about $12 trillion that has to be refinanced at higher rates. So do you think that the Fed is going to be sitting here engineering rates higher in the face of this, with Scott Bessent, the new Treasury Secretary, sitting on a time bomb of debt? Of course not. So what will they do? This is the punchline of the whole, your initial question of where do we go for assets? You've got to own hard assets. So now you get into this week where it seems like, God, the energy prices are going up so much that it's not just inflation. Now we're talking about demand destruction. So you've got the Treasury worried over here. You've got investors worried about inflation. Then you've got investors now worried about demand destruction because everything's so expensive. So what happens? Well, the Fed funds futures come down because people realize that, there's no way they can raise rates into this. It would be absurd if they did that. We'll head into a recession. And then that $12 trillion that we just talked about refinancing would turn into 13, 14, 15 trillion because a recession would just cause the deficit to blow out even more. So we're on kind of a tenuous situation here. And if you think that they don't know this in DC, of course they do. They're not stupid, But the other thing that has to play into all of this, Giovanni, is the politics. Because now we're coming up on interim, the midterm elections. And so do we want to have a recession heading into the midterm elections? Of course not. So Trump is going to do whatever he has to do to try to resolve this conflict, in my opinion, before we get into the summer, late in the summer, because you've got elections coming up, and this is not a popular thing.
At the heart of Lavish's analysis is one critical variable: energy. Energy prices don't just affect fuel, they affect everything: manufacturing, transportation, food production, supply chains. When energy prices rise, the cost of everything rises. This creates structural inflation, which is far more dangerous than temporary price spikes. The Federal Reserve understands this, and it puts them in a difficult position. Initially, markets expected rate cuts, but as inflation concerns intensified, particularly driven by energy, expectations shifted dramatically. Suddenly, markets began pricing in no rate cuts, potential rate hikes. This caused bond yields to rise, signaling growing concern about long-term inflation.